All right, good morning, good afternoon, everyone, and thank you for joining us for today's Kaplan webinar, which is going to be on economics and taxation, and it's going to be 1 hour today. So my name is Marie Sikowski, and I have been an instructor for Kaplan for about 21 years now, so been doing this for a while. I teach a variety of securities classes. And as a reminder, these webinars are meant to be just an introduction to the various topics that are covered on all of the exams. So please understand that the test will expect much more from you than what you'll be learning in the next hour, but it is a start and will give you a good foundation as you continue your studies. So let's just deal with some housekeeping up front to address some common questions. There is going to be one more live webinar that'll be on Monday. So if you're going to ask, can we sign up for more webinars? There's only one more, and that's going to be Monday. That's going to be Anatomy of a Question. That's going to be an hour and a half. And so that one, I'm sure you don't want to miss that one. So if you want to sign up for that, our moderator today is going to be Mark. And Mark, as our moderator, we'll post the link for you. He's also going to be conducting that webinar on Monday. So you can post questions to him in the question box, and you can look for the link in that question box as well. That'll take you to the sign up for that webinar. It will also provide you access to all of the archived webinars in case you missed any or want to go back and re-listen to those. Anybody can go to the archived webinars and listen to those if they choose. So that's it for the webinars. Monday will be the last live one. I don't know of any new ones that have been scheduled, but like I said, you do have access to the archive. All right, as far as this webinar, it is being recorded, and you will get, excuse me, a copy of the recording just automatically. That'll be sent to you. Usually it's about within 2 to 3 days of 2 to 3 business days of the session. So look for that sometime at the beginning of next week. If you have audio issues, bandwidth, as we know, is at a premium these days and being stretched very thin. Tends to be a lot of individual issues with the audio. So if you're having difficulties, you just got to test your own audio. GoToWebinar has a little button there. You can test your sound. You might try going out and coming back in. But in general, what we've seen is it's just been just some random individual issues with the audio. The other thing, keep in mind, is that the recording will be available to you, and that will not have any audio issues in it. So you can always re-listen on the recording. All right, questions. I mentioned Mark is going to be our moderator today. You can post your questions pertaining to this topic and this topic only, please, in the questions box. As you're doing so, please reference the slide number for him, so in case he gets backlogged, he can know what your question is referring to. He can look at the slide and answer it that way. Okay, I think that is about it for just kind of the housekeeping issues. So we'll go ahead and get started. So we're going to be talking today, as I mentioned, and it looks like I'm sure you all know, economics and taxation tends to be one of those topics that a lot of people struggle with. It's not, for most people, the most exciting topic, but it is a big topic on all of these exams. So it's a really important concept to have some understanding with. So, and if you get down to what it's all about, economics is really just all about supply and demand, and how that supply and demand affects things like jobs and wages, manufacturing, banking, as well as all areas of our lives. So since interest rates is just one of the tools used to keep the economy humming along, you need to have, like I said, a basic understanding of economic principles that you can anticipate how your clients' investments could be impacted, or to even know what kinds of investments would be most suitable for them, given the economic outlook. So economics and taxation are two areas that are intertwined with suitability, and suitability, of course, is a very big part of the exam. So you don't need to be an economist, so don't worry about that. You don't need to be an accountant. You don't need to have a financial background or a financial degree. And if you do, you certainly don't want to get overly analytical with any of these concepts. Remember that you just need to answer what they're asking. Okay? Look for the keywords that they've provided and pick the answer that fits the key words. You don't have to agree with it. Just pick what you think they're going to want to see as an answer. Okay, and certainly don't think of real world. Okay, this is not a real world test. So, just giving you an introduction. So the only thing you're seeing right now, I'm going to change right now. We're going to talk about what you're going to hopefully take away from this webinar. We hope that you are going to, at the end, be able to understand what is influencing the economy. We'll look at a couple types of financial statements you want to be familiar with and recognize the tax consequences associated with different types of investment products. So the economy, as I mentioned, is driven by supply and demand. And that supply and demand is for goods and services, and that supply and demand goes through cycles. So you absolutely want to be familiar with the 4 phases of the business cycle. And those 4 phases move something like this, right? Expansion, which is the phase of growth, and then at some point the economy will peak. That's the point of prosperity. Then the economy turns and we head into a period of decline, or it can be known as contraction. And then the economy finds a bottom, or a trough as it might be referred to, and then the cycle starts all over again and goes into recovery mode. So this business cycle, or the economy is what we're referring to when we talk about the business cycle, moves always through these phases sequentially. So like you couldn't go from expansion to decline. You have to go through expansion, peak, and then decline. So you can't jump over any of these phases. So know them in order, but be familiar with the 4 phases of the business cycle. Now, knowing where the economy is at with regard to the business cycle is what's important, because that can help us anticipate where the economy might be headed. And it can also give us an idea of where interest rates might be headed. And the movement of interest rates, of course, has implications for bonds as well as stocks. So how do we know where the economy is at in the cycle? Or how do we know where we're at? Well, there are lots of various economic indicators. We're not going to get into all of those on this webinar. We are going to touch on one, and that's GDP, and we'll define that on the slide coming up here. But I want to slot it in here so you can associate GDP and how it relates to these cycles. So GDP, gross domestic product, which measures how much we are producing in this country, all the goods and services produced in the U.S. When GDP is rising, that defines the economy as being in a period of expansion. So they'll watch the GDP number. As long as it's rising, the economy is deemed to be growing or in a period of expansion. They watch for signals that the growth is peaking, and then when we get negative GDP, then that will be a sign that the economy has changed direction and has headed into the decline or contraction phase. We'll talk more about declining GDP. They'll watch that pretty closely because that can put up some other red flags as well. But declining GDP, or negative GDP, I should say, indicates that the economy or the business cycle is in that decline or contraction phase. Watching that closely for signs that the trough or the bottom has formed. And then when we see positive GDP once again, then that will signal that the economy is on the recovery mode. So GDP, very important. It's a very widely and very important number that is paid attention to. It measures for us the health of the economy. So when GDP is rising, obviously growth and expansion is good. We like to see that in the economy, but they do keep an eye on that, because growth, if we get too much growth too quickly, that is not good for the economy. That can lead to what's called inflation. Okay, and we're going to be talking about different types of policy that can be put in place to keep inflation in check, also to help stimulate the economy along if it gets sluggish. So this is why understanding the business cycle and the cycles, or the phases of the business cycle, are so important. Okay, so I mentioned GDP as one of the factors that you would want to pay attention to, and GDP stands for gross domestic product, GDP, gross domestic. So domestic meaning everything that is produced here in the U.S., and that is not just U.S. companies, but all companies that are manufacturing here in the U.S., because those companies employ U.S. workers, and they get paychecks, and they put those paychecks back into the U.S. economy. So for instance, Toyota, a Japanese company, we know has several manufacturing and assembly plants here in the U.S. They have one in Texas, and that plant in Texas, the trucks that are coming off the line there, those trucks would be considered part of the U.S. GDP number, even though they're being manufactured for a Japanese company. They're being made here in the USA. So made in the USA, it's part of GDP. Okay, the GDP number is a quarterly number. It's published quarterly. And again, watching it to tell us whether the economy is growing, or that would be with a positive GDP number, or if we see a negative GDP number, as we just saw with the business cycle. So I mentioned that when it goes negative, that can cause some concern as well, because it depends on how long we have negative GDP. They watch that, and again, GDP is a quarterly number. So if economists saw 2 consecutive quarters, and yes, you do want the word consecutive in there, make sure that they're talking about 2 consecutive quarters of declining GDP, then the economy would be defined as being in a recession. Okay, so that's the formal definition of a recession, when we have 2 consecutive quarters of GDP, which be careful, because 2 consecutive quarters, how else could that be expressed? How about 6 months, right? 2 quarters is 6 months. So they could express it either way. So you have to read very carefully and really pay attention to the answer choices, because you might be looking for 2 quarters, you don't see it, or you see a number with a 6, and they're defining a recession, and they put 6 quarters. Well, 6 quarters is not a recession. 6 months recession, but 6 quarters, yes, that would be really depressing, because that would be about 18 months worth of declining GDP. So I would definitely know the definitions for recession and depression. All right, but so to make sure that economists have a true picture of what's going on with this GDP number, because there's always inflation present in the economy. It's naturally going to be there. So over time, prices just naturally are going to increase. So when they're measuring how much, what was the value of the goods and services produced this quarter, they're looking at the value, the prices of those goods and services. Well, if they're comparing that to whether it be last quarter or a year ago at this time, they can't use that GDP number as it is, because we don't know if the number is bigger just because of inflation, or are we actually producing more? Is demand still driving the economy? So in order to have a true idea of what's going on with the economy, you have to factor out inflation. And so they do that with another indicator known as the CPI, Consumer Price Index. So the Consumer Price Index is used as a measure of inflation. So if you ever see, even in a question, if it references like CPI is 3%, they're telling you that inflation is 3%. So we use the CPI to measure inflation. And so what they'll do is they'll take the GDP number, and this is the economists, right, and they factor out the inflation, the CPI number, they'll factor that out of GDP. And then that number that's left, which is known as real GDP, that's what they use to compare to again, the previous quarter or the last year, whatever time periods they're comparing, they use real GDP, or GDP that's being measured in what are called constant dollars. And constant dollars are dollars that have been adjusted for inflation. Okay. Now, inflation, of course, causes prices to rise. And for certain types of investors, particularly those that are receiving fixed income, it's going to be of a particular concern for them, because they're getting the same check, the same amount month after month or quarter to quarter. It's a fixed amount, and that amount of money will buy them a certain amount of groceries, right? Maybe it'll buy them $100 worth of groceries right now. but because of inflation, or what's called purchasing power risk, right? Another way of saying inflation is purchasing power risk. We definitely associate it with fixed investments, and over time, that same basket of groceries is not going to cost $100 anymore. It's going to rise in time. So for someone or an investor who's worried about inflation, fixed investments are not the thing you want to recommend. They got to have some way to grow faster than inflation. All right, so what does CPI measure? So we've kind of talked about this already. It measures the change in prices. So when prices are rising, we would refer to that as inflation. And in recessionary times, when prices are declining, then that would be referred to as deflation. So you can think of it as a balloon even, blow up a balloon, you inflate the balloon, it rises. If you deflate the balloon, okay, it falls back to the ground. Coaster, and so that would be inflation, but then it hits that middle part with a little stagflation sign, and you'll notice a level patch there on the roller coaster tracks. And so stagflation is just that. It's when the economy is stagnant. Stagnant means little to no growth. Okay, and normally if there's little to no growth, we would not expect prices to be rising. We wouldn't expect there to be a lot of demand pushing prices up, because generally it's a time when people are out of work and unemployment is rising. So you wouldn't expect demand to be present. But with stagflation, it is a situation where you have a stagnant economy, yet prices are still rising. So stagnant economy plus inflation, put them together, you have stagflation. So what are the forces at work that are keeping the economy in check? Well, there's two types of policy at work, and you'll want to know about both of these types of policies and who sets these policies and other keywords that you'd associate with them. So the first type of policy we're going to talk about, monetary policy. The word monetary kind of gives you a clue. It looks very close to the word money, doesn't it? So in terms of monetary policy, who is it that sets monetary policy? Well, that's going to be the Federal Reserve Board. You might see it just abbreviated FRB, or they might refer to the Fed or the central bank. If you see that, that is the Federal Reserve Board. And we've got a picture here of letting you know what it is that the Federal Reserve does. And they do quite a number of things. We're not going to go through all of these. Of course, you can look through all the things that the Fed does. We're going to focus on the managing inflation. So this one right here is what we are going to look at. So if you think of the Fed's role in terms of managing inflation. So we talked about inflation is when prices are rising too quickly. The economy is becoming overheated. It's getting out of control. And what happens is that when the economy becomes overheated, it can form a bubble. And the problem is that bubbles at some point burst. And we've all lived through experiences with bubbles, most recently the housing collapse and that housing bubble. But so with regards to managing inflation, particularly, how does the Fed do that? Well, think about what's driving the economy. We just talked about it. It's demand for goods and services. And what is it that's driving demand? Why are people demanding those goods and services? Because what do they have in their pockets and in their bank accounts? They have money, right? And who is in control of the money supply? Well, that's the Fed. So the amount of money available in the banks, that's the money supply. The Fed is in control of how much is or is not available. So how can they influence the amount of demand? Well, if you make money cheaper to borrow or make it more expensive to borrow, the cost of money, okay, definitely will have an impact on how much is finding its way into the economy. And the cost of money, of course, is interest rates. So for instance, if interest rates were rising, I might hold off on buying that house or that car that I might have been thinking about, or maybe I thought about starting a business, but I'm going to wait because I'd have to borrow a bunch of money and that would be a little costly now. And with rates rising, it might not be a good time. But if rates are low, I might be more likely to borrow. Okay, it's more of an incentive. Wow, low rates, right? Fed dropping rates now. A lot of people looking, they're refinancing their homes, perhaps looking at buying homes, maybe buying that car, starting that business. So you go borrow that money, and then that money ends up finding its way back into the economy. So when the Fed is taking rates low, they do that to try and stimulate demand. They make money cheaper. But when they're worried about inflation, that's when they're going to want to put the brakes on the economy, slow it down, and they'll take steps to raise interest rates. So let's look at how exactly the Fed might do this. Sorry, I had to get rid of my little pointer there. Let's look at the tools that they have at their disposal. Okay, there are three tools that they have available to help them manage the economy. The first one, which is the most widely used tool, most frequently used tool, has to do with taking money out of the money supply or putting money into the money supply through what are called open market operations. Okay, and there's a committee within the Federal Reserve. It's known as the FOMC, Federal Open Market Committee. And what they do is they meet, and it's roughly about every 6 weeks, between 6 to 8 weeks, and they take a look at the economy to see if it's moving in the direction that they want to see it going in. So this is a committee made up of heads of various banks, right? So they're monitoring the money supply and the banking system and deciding if the economy is moving the way that they want it to go. So is it moving at the right pace? Is it moving too quickly? Is it moving too fast? Well, I guess that would be too quickly, too fast. Or is it not moving fast enough is what I meant to say there. So if that's the case, that they feel that they need to step in and take action, then they can engage in these open market operations. What they do is they engage by buying or selling treasury bills in the open market. All right, so I would definitely be familiar with references to, if the Fed announces they're buying T-bills, what does that mean? If they're selling T-bills, what is that going to mean? So if the Fed announces that they're going to begin buying T-bills, that means they're going to be adding money to the money supply. So think of it, if you want to just keep this simple, right? The Fed is buying T-bills. Well, just liken it to yourself. When you go out and buy something, right? Maybe you bought some takeout, or the last thing you made a run to the grocery store and perhaps bought something there. When you buy something, you have to loosen your purse strings, right, to get the money out. You have to ease that wallet open to get the money out. And when that money comes out, it goes into the cash register. So think of the Fed doing the same thing. If the Fed is buying, okay, they're going to loosen their purse strings. They're buying T-bills. They're loosening their purse strings, and that is going to put money into cash register, but that's the money supply. Okay, so when the Fed is buying T-bills, okay, they are easing, right? Easing, we would say it's an easy or loose monetary policy. And if they're trying to put money into the money supply, they're trying to make money more available. And if money is more available, then that will help stimulate demand, right? And if there's more money available, that'll send interest rates down, which makes it attractive to go and borrow, and that's what stimulates demand. So buying T-bills, easy monetary policy, loose monetary policy used to stimulate demand in times of recession, and the act of buying the T-bills is done to help send interest rates down. That's what stimulates the demand. Okay, on the opposite side, when the Fed announces they're going to be selling T-bills, well, again, think about yourself. If you sell something, you receive money. And when you get that money, you hold it tightly in your hand, right? That money is not floating through the economy. It is held tightly in your hand. So tightening, okay, taking money out of the money supply. When the Fed is doing this by selling T-bills, they're doing it to try and slow down the economy. Why might they be doing that? Because they are concerned of inflation. So selling T-bills, associate that with tightening, taking money out of the money supply. If there's less money available in the banks, what effect will that have on interest rates? It will send interest rates up. Okay, so very important tool, very widely used, has a very immediate impact on the money supply. Okay, the next tool is the discount rate. This is the only actual interest rate that is set by the Fed. It is the rate that they charge their member banks, other banks. If banks need money from the Fed, if they need a loan, and actually the Fed would be the lender of last resort, really. So it's not a good sign if you see banks going to the discount window, as it's called, to borrow money. But if there is a crisis situation and they need money, then the Fed says, we will lend to you. This is the base rate for all actually meet the shore. So that's the same idea with a multiplier effect. So the Fed, if they're wanting to see some immediate results, they don't want to wait for that ripple effect, that multiplier effect to take hold. So that's why this is the tool of last resort. Right, so that's kind of the highlights for monetary policy. That's the Federal Reserve, and again, has to do with affecting interest rates. So interest rates is a word you would put together with monetary policy. Okay, you would not associate interest rates with the other type of policy affecting the economy, which is fiscal policy. This one is the domain of Congress and the President. They are responsible for setting our fiscal policy. And so you might think, well, so how can Congress and the President have any impact on how much money is floating through the money supply? Well, if you think about it, Congress is the one that writes our tax code. So through changing the tax code, like they're doing now, sending out stimulus checks, and they offer various credits when you do your taxes, right, to try and give people more money, give businesses more money, all ways to put money back into the system. And certainly they also control how much the government is spending in and of itself. So the two tools, tax and spend, as they like to refer to it, that is fiscal policy. So when you look at a government and say, what is their tax and spend philosophy, really what we're saying is, what is their fiscal policy? Now, there's different perspectives about how involved the government should be or not in getting involved with manipulating the economy, and that is what this is intended to do, move the economy in the direction they want it to go. So there's two major fiscal policy theories. The first one we see here is demand-side economics. And demand-side economics believes, well, first off, if you're following demand-side economics, you want to recognize that word Keynes, Keynesian theory, or Keynes. Keynes was an economist, or is an economist, that is associated with or accredited with this demand-side economic theory. And his theory was that if the government really wanted to stimulate the economy and spur growth, that the best way to do that is to give money to moms and pops, if you will, consumers, right? Let individual people, average people, receive different forms of stimulus. They, in turn, will put that into the economy by buying things, and that will stimulate demand, and that will continue to spur growth in businesses. So if you're a Keynesian, then you would go along with the belief that then lowering taxes, that would put more money in people's pocket, increasing federal spending would put more money into the economy, and lowering taxes puts money into people's pocket, which goes into the economy, and therefore encourages economic activity. But if instead the government took steps to raise taxes, well, gosh, now we won't have as much left over out of our paycheck, and companies are paying more, and the government's not spending as much, so that will tend to slow economic activity. All right, now, the opposite side of that, supply-siders believe that giving tax breaks to businesses and the wealthy is the way to go, since the wealthy people are typically the ones that own all the businesses. So if you give businesses tax breaks and wealthy people tax breaks, then they in turn will allow that to trickle down to the moms and pops, if you will, the everyday people. So that's the theory behind supply side. So terms here known as trickle down economics, meaning give, again, those cuts to the corporations and to the wealthy and let it trickle down. Reaganomics, okay, under Reagan, that's what it was referred to as Reaganomics, and then something called the Laffer curve. Again, don't need to know what these things are, just need to know that these are all terms that you would associate with supply side versus Keynes you would associate with demand side. Demand side says give the money to individual consumers, let them stimulate the economy. Supply siders say no, give it to corporations and wealthy people and let them trickle it down to individual consumers. Okay, so the value of the U.S. dollar also impacts the economy. So kind of moving forward, we're going to look at other things that impact the economy. And so one of those, yes, being the value of the U.S. dollar. We buy and sell, with countries all over the world. And since foreign currency moves inversely to the value of the dollar, the test will want you to understand how currency fluctuations can affect our balance of trade and create things like surpluses and deficits. So when we talk about currency, we have to have an understanding of what's going on with the exchange rate. Okay, so exchange rate, so for instance, you hear all the time in the news, they'll talk about the dollar weakening, the dollar strengthening. So what exactly does that mean? Well, we've got a little picture here of a race, and here you've got the US dollar running a race with the euro, and the US dollar in this case is not doing it. And so what that means is, think of all the imports here. We're importing foreign goods. If they're more expensive, then consumers here aren't going to buy as many of them. So imports will decrease. But the good thing about a weak dollar, so it's not good if you're going on vacation or if you're looking to buy, imported goods. But if you are a U.S. exporter, it's actually very good, because U.S. goods that are being shipped overseas will actually be cheaper. When the dollar is weak, U.S. goods are cheaper. And so what that means is that exports will increase because of the lower cost of U.S. exports is going to increase demand, right? So if U.S. goods are cheaper, when they get over to Europe, let's say that U.S. made shirt is on the shelf next to a shirt made in Paris, and let's say that they were of equal, everything being equal except the price, okay? If the U.S. made shirt is cheaper, then more people will buy that shirt, which means that money comes back into the U.S., back to that company, and their profits go up. So if you are an exporter, this is just one thing that I would just remember and memorize and know, and just use this as kind of your touchstone and thing to think about. Exporters, regardless of what country, exporters want their home currency to be weak, right? That's why China for so long kept their currency depressed, right? Because they're a huge exporter of goods, and that's why things are so cheap for us when they come over here, when their goods arrive, because of the differences in the currency. So if I'm a U.S. exporter, I want the dollar to be weak. If I'm on vacation, I don't want it to be weak, but if I'm an exporter, I do. So business wants to see a weak dollar. Okay, and we'll talk about, again, this would lead to more exports than imports, so that'll lead to a surplus. Now, if the dollar is strong, then you can imagine, just the opposite. So if you need to, you can think of that race that we just saw. Now the dollar would be winning. The dollar would be in the lead, okay? And so in this case now, if you gave me $1, you would actually get, let's say, consider like $1.05 equivalent of euro. So you give me $1, I'm going to give you more than $1's worth of euro, because the dollar is strong now. So the dollar is winning the race. So your dollar will buy you more foreign goods. If you're on vacation, You want a strong dollar because, yeah, now it will buy you more. You get more euro with $1. So since foreign goods are cheaper, the sale of imported goods will go up. Goods coming into the U.S., if they're imported goods, will be cheaper for us here in the U.S. because our dollar is strong. So we might be tempted to buy more imported goods, which will increase the amount of imports. But remember, if you're an exporter, you don't want a strong currency. Okay, that means now U.S. exporters, their goods are going to be more expensive overseas, and therefore their demand will go down for those goods because they now cost more. All right, so and exporters don't like to see their currency strong. So in this case, there would be more imports than there are exports, and that will lead to a deficit. All right, so we can summarize this surplus and deficit in what's called the balance of trade. So balance of trade has to do with, again, whether a country has more exports to imports or the opposite, more imports to exports. So a surplus will be created when our exports exceed imports. So I'm going to kind of go down here at this little scale, right? Exports, remember, exports is goods going out of the country. Goods go out of the U.S., but what comes back into the U.S.? Money, right? Goods go out, but that brings money back into the U.S. Money into the U.S. will increase the money supply. More money in the money supply is good. That's going to expand the economy. So when the exports are greater than the imports, then that is what creates a trade surplus. But just the opposite, let me bring up the scale there, when the imports are greater than your exports. Imports, again, imports, goods are coming in, foreign goods coming into the U.S., but that means money has to leave the U.S. to pay for those imports. So there goes money, bye-bye, it's leaving the U.S. So money leaving the U.S. means the money supply is going to decline. There's not as much money in the money supply anymore, so that's going to slow down the economy, okay? And so that's what creates a deficit. More money going out than more money coming in. All right, so we've talked a bit about the economy, what drives it, and why that's important to understand. Again, it's a measure of how healthy the economy is. But as an investor, you might say, but I'm investing in individual companies. How would I know how healthy they are? Is there any way of knowing how healthy an individual company is? Well, certainly there is, right? You can look at their financial statements. And so we're just going to briefly touch on those. Again, please, on this next slide here, I'm going to bring up a balance sheet for you. That's certainly one type of financial statement that can be handy. And don't get scared with what you see here, this big balance sheet. Again, you're not expected to be accountants, but you do need to understand why someone would use a balance sheet, what benefit it provides to the investor. So the benefit of a balance sheet is that it will help you determine exactly that. What is this company worth, right? So you can figure out, do some analysis and figure out whether you want to become a long-term investor, whether the current market value makes sense or not. But a balance sheet helps an investor understand what a company is worth and or what its value or valuation is. So, and you'll notice that the corporation here, it's XYZ Corporation, and it says as of December 31, right, 2020, let's say, or 2019, because we don't have a time machine, so 2019. And at December 31, 2019, this is like taking a snapshot in time and saying, all right, I want to know as of this date, what exactly did this company own? So the assets, what did it own? And what did it owe, the liabilities? Okay, if you take the assets, subtract the liabilities, okay, subtract the total liabilities is what you want to subtract, and that will give you what's called net worth. So actually you'd want to use the total assets, and I would know this formula, total assets, subtract total liabilities. That will leave you with what's called net worth. So that's one way that you can compute the equation for the balance sheet. The other way, if you look at this side, liabilities plus net worth together, those two pieces together should always equal the total assets on the other side. So this is a balance sheet. Again, I'm not going to get into a lot of detail here with the balance sheet. So if you need to study this more, you can look to your books. Assets are things that the company owns. Current assets, very liquid. Fixed assets like buildings, plant, and equipment. Land thrown in there as well. Those are your fixed assets. Current liabilities, those things that are coming due in the next 12 months. Long-term liabilities, anything longer than a year. And then net worth is the capital that was raised. And you'll also notice here something called retained earnings. Those are the profits that the company earned that they held on to. right? So they retained, they had earnings and they retained a certain portion of them. So we're going to see where those earnings come from on the next balance sheet. And that, I'm sorry, not the next balance sheet, the next financial statement, and that's actually going to be the P&L. Before I leave this, though, I do want to mention here with regards to net worth, because this is something certainly I've had students comment that sometimes they use different words on the test or even in questions. And net worth is one of them. Net worth can also be called owner's equity, can also be called shareholders' equity. So if you see any of those terms, owner's equity, shareholders' equity, net worth, they're all the same thing. Okay, and once again, I would be familiar with basic balance sheet equation. You should also expect some calculations, depending on which test you're taking. There might be more calculations related to a balance sheet than other tests. So just know that you may want to be familiar with some of the calculations or formulas that involve computations using information from a balance sheet. You can use your books to give you guidance as to what you need to know there. Okay, all right, so the next financial statement is the income statement, or the P&L. So the P&L differs from the balance sheet in that you'll notice that a P&L looks at a period of time. This is looking at the month ending September 30. So it looks at a period of time, whether that's a month, whether that is a quarter or a year, okay? And it looks at really whether or not did the company make money, okay? Here's their sales, cost of goods. Notice that they're paying suppliers, they're paying their creditors, they're paying their taxes, and they also paid, before we get to the dividends, after they paid they have to pay creditors and have to pay taxes, they pay their suppliers. This net income after taxes of $35 million, that was the profit really they had left over. Now, with that profit, they can decide, the company decides, what are we going to do with this? Are we just going to hold on to all of this, retain all of this for ourselves and reinvest it into the company to grow the company? Or do we want to share this with some of our shareholders, give them back some of that profit in the form of a dividend? And that's what they've done here. So in the end, retained earnings here, in this case, $33,200,000, that's what goes into retained earnings. So the income statement helps you to decide or know whether or not this company is making money. Again, here you could have some calculations with regard to a P&L, but use your books to guide you as to whether or not that's something you need to worry about, and if so, which formulas. All right, taxation. As far as individuals, right, we are subject to lots of different types of taxation. So progressive taxes, the idea that the more you make, the more that you own, the more taxes you should pay. So income taxes and estate taxes are an example of that. But we also have regressive taxes that we're subject to. Those are what are known as flat taxes. And this is where everybody pays the same. And so an example there would be like a sales tax or a gas tax. Those are not dependent on your income. And if you're in a lower income bracket, then actually regressive taxes are actually more punitive to people in lower tax brackets. So progressive and regressive, no examples of each of those types of forms of taxation. Now, earned income, you know what that is, right? So that is income you work for, and could be salary, hourly, commissions, royalties, but you worked for it. And earned income is taxed at an ordinary income tax rate. You don't need to worry about knowing tax brackets. They would give you any of that type of information in a question. And not only are we working, but if you have an investment portfolio, hopefully that's working for you too. And investment income, you can think of that as the paycheck that your stocks and bonds are bringing home to you. So you only get income from securities that you own. Once you sell them, no more paychecks and no more income. So please do not confuse income with profit. A lot of students do this. It's not the same thing. So when you see those key words in questions, suitability words, income and profit are not the same thing. So income, you want to think about, the paycheck that a security is bringing home to you. So income, since it's like a paycheck from your securities, it's taxed like your paycheck is taxed as ordinary income. Now, dividend income, however, does get taxed at what they'll call favorable rates, which just means lower rates. Okay, bonds, your bond interest, that is taxable as ordinary income, but who you pay tax to can depend on who the issuer is, or will depend on who the issuer is. So who the issuer of your debt security is will dictate whether you're paying taxes to the federal government, taxes to the state, one or the other, or maybe neither one. And again, we're talking just about taxation of bond interest. So corporate bonds, the interest income taxable at the federal level and the state level. U.S. government securities, federal level, but not the state. Municipalities, never federal. maybe the state, and territories like Puerto Rico, Guam, the Virgin Islands, so U.S. territories. In this case, you wouldn't pay tax to the federal or the state. So familiarize yourself with those. If you need a refresher, taxation of bonds covered in your bond section or the taxation section in your books, but always taxed as ordinary income. This is just the interest. Remember, capital gains of any security are always going to be taxable. All right, and speaking of capital gains and losses, these are going to arise from when you sell an investment, when you actually sell an investment. So I like to remind students that when you have tax questions and they're asking, how would this be taxed, as ordinary income or capital gains, capital losses, you can't pick capital gains or capital losses unless the investor has sold something or they've redeemed something or it's matured. They no longer have that investment. Then you have a tax consequence. You either made money or you lost money on the investment. So please keep that in mind. You have to have sold the investment in order to end up with capital gains or capital losses. Now, if you had a gain, then whether that's taxed as long-term or short-term capital gains will depend on how long you own the security prior to selling it. Okay? If you own the security for 12 months or less, that is going to receive short-term capital gains treatment, which means the gain will be taxed at your ordinary income rate. So it just gets lumped into all the other ordinary income you're reporting and gets taxed at the same rate. If you owned the investment for more than, and the key here is more than 12 months, not 12 months or longer. Look, 12 months is over there on short term. More than 12 months, then it's eligible for long-term capital gains treatment, which means that the most that someone would be subjected to here is 20%. That's the very most. So those are capital gains only when you sell a security. Very testable. And I would know the holding periods, absolutely. So we have an example here, and I'm going to go through this fairly quickly. You can always come back and revisit this in the replay if you want to study it a little bit longer or kind of follow it, take your time with it, but I'm going to move through it since we're coming down to our last few minutes here. So Mr. E here reported income of $150,000 in 2019. He'd also sold stock and generated gains of $7,000 in 2019. But in 2018, he had losses of $19,000, which he is carrying forward. Okay, so they highlighted that. That means he's got losses from prior years that he wasn't able to use to his advantage, so he's allowed to carry those forward until he can make use of them. So they want to know what is his gain or loss in 2019. So in 2019, he made $7,000 in profit. He had capital gains. So those would be taxable as capital gains, we would think. But the way it works is if you have gains, before you compute tax, you're allowed to offset your gains by any amount of losses that you might have. Okay, now he didn't have any actual losses generated in 2019, but the losses he's carrying forward from 2018 say that he can take 7,000 of those losses and cancel out the gains in 2019, leaving him with 12,000 as a remaining loss that is now there to use in other ways that he can find to use up these losses. So he's already applied 7,000 of those losses against his gains for this year to eliminate the tax consequences on the 7,000. All right, now he's got though 150,000 in income. So the question says how much income will he pay taxes on? Well, here's the other thing to keep in mind. If you've read through the chapter, then you know that there is an allowance that the IRS allows if you have gains that are still unused, okay, that you can take a maximum of 3,000 of those gains and use that to reduce your taxable income. So his taxable income would actually drop down to 147,000. He's applying 3,000 of those losses against income to reduce his taxable income. So out of the 12, he used 3 to reduce the 150 down to 147. That leaves $9,000 that he's not been able to use this year. So since he couldn't use it this year, what will happen to those 9,000 of remaining losses? He'll carry that forward into 2020. And you can carry losses forward until you're able to use them all up. Okay, so you can carry them forward indefinitely. All right, now there are a couple other tax situations you need to be familiar with here. One has to do with gifting of securities. So here we have a lady who wants to give her niece shares of stock that she bought at $30 a share. So if she makes a gift, notice it says the donor's original cost basis passes to the recipient. So the niece is receiving those shares at $30 a share. So what does that mean? When she goes to sell those shares, let's say she sells them at $90, she's going to plug in a $30 cost basis and have to pay taxes on that $60 capital gain. However, gifting is not the same as inheriting securities. Let's say the aunt, dies, right? So she passes away, and when she passes away, she leaves these shares to her niece through the will. So the niece receives the shares. She's not happy about her aunt dying, but she is happy because those shares receive what's called a step up in basis, which means her cost basis will become the value of these securities at the date of her aunt's death. So if that was $85, she's receiving those shares at $85 a share. If she sells them at $90, now she's only paying taxes on $5 capital gain is what she'd report. Okay, so quite a difference there. You only get the step up in basis when securities are inherited, and they step up to the value at the date of death or 6 months after, whichever is more favorable. But gifting, you're also giving somebody your cost basis with that. And then lastly, the last two scenarios we're going to talk about have to do with annuities. Okay, so annuities, these are retirement plans, so please keep that in mind. And as a retirement plan, when you have an annuity, you start off, in this case, this would be what we call a non-qualified annuity. I am putting in after-tax dollars, and that's what cost basis is denoting. When you see cost basis, that means I took my own money out of the bank and used it to invest in this annuity. So $10,000, that's already been taxed. That means when I pull it out of the annuity, this cost basis, I will not have to pay tax on this when it gets distributed from the annuity. But an annuity is a retirement plan. So when I put this $10,000 in, it's going to grow tax deferred. And let's say that it's grown to a current value of $25,000. So there's growth of $15,000 there that has to be subject to taxes when it's taken out. If I take a lump sum withdrawal, that's exactly what's going to happen. I'm going to withdraw all of it, $25,000. I'm going to subtract out the $10,000 of cost basis because that I already paid taxes on, so they won't tax me again on that. But that $15,000, which is the growth, that absolutely is going to be taxed. And because this is a retirement plan, here's the thing to remember: anything that's had deferred growth, if there are tax consequences, those tax consequences will always be ordinary income, never, ever capital gains with distributions from any type of retirement plan or anything that's had deferred growth. Okay, so that's lump sum. So your investor here would be getting $15,000 that would be considered taxable as ordinary income on top of any other ordinary income they have. So that might push them into a much higher tax bracket than they want to be in. So rather than take a lump sum, they said, well, how about I just take out some of it? Well, you can do that. You can take what's called a random withdrawal. Take what you need when you need it. So this one's going to start out with $15,000 in cost basis, and it's grown $5,000. $12,000. Remember, it's been growing tax deferred. So that is definitely going to be taxable when it comes out. The $15,000, not going to be taxable when it's distributed, but the $20,000, absolutely. So with random withdrawals, the IRS is very anxious for you to start taking money out, and they're going to require that when you pull money out of an annuity, any growth always has to be the first money that's distributed. They apply what's called LIFO tax treatment. Last in, first out. The last money in is all that growth. That's all the new money. So when you go to take a distribution, a random withdrawal, so there's $20,000 of growth. That's just, the IRS is just waiting for you to take out. And this investor wants to pull out $9,000. So you have to figure how much growth has accumulated there. And you have to, that all has to come out first before any of that cost basis starts getting returned to the investor. So $20,000 of growth, $9,000 comes out as a random withdrawal. It gets taxed as ordinary income, all right? And that leaves $11,000 of growth still yet to come out, okay? Investor comes in and says, all right, I want to pull out $12,000. I want to take another random withdrawal of $12,000. Oh, well, they've only got $11,000 of growth. Yeah, but they've got a bunch of cost basis in there on top of that. So go ahead. They'll distribute the $11,000. That's all subject to tax, ordinary income, but the additional $1,000 they wanted, that's going to come from the cost basis, and that is not subject to tax. So the pieces that would be taxed here would be the $9,000 and the 11,000. Okay, it's two pieces together making up 20,000, equal to the amount of growth. So please remember, LIFO tax treatment only used in connection with annuities, random withdrawals, subject to LIFO tax treatment. These are life insurance products. So LIFO treatment for life insurance products, annuities, random withdrawals. All right, my friends. That is the end of our webinar today. I appreciate your time very much. I'm going to leave the question box open for a bit. So if you're in there with questions or waiting for Mark to get back to you, I will leave that open. Once again, we thank you very much for your attendance, and we hope you found these webinars helpful. And don't forget to catch us on Monday for the very last one. Take care, be safe, and good luck on your exams.